Okay, so good morning, good evening, good afternoon, good night, everyone. We are from Group V. Today, we want to discuss about the study case that we have is 1 until 4. So before we start, let us introduce ourselves. My name is Flora Safitri Priyapsa.
My name is Karina Damayanti.
My name is Tias Mahardika Ramadan.
My name is Rama Kurnia Pradana.
So today is the subject institution and financial market. Okay, so the study case number 1 will be presentation for by me, Flora. Okay, so for the case study number 1 is about expansion of Nova Animation Studios. Next. Okay, so Nova Animation Studio is a well-established animation company operating in Canada. In recent years, the animation industry has experienced rapid growth with increasing demand for high-quality animation contents. So, however, the project requires a significant initial investment of $4 million. As a part of the financial analysis, the team has projected the expected cash inflows from the expansion. According to estimates, the project is expect to generate annual cash flow of $675,000 for 16 years. To assess the feasibility of the investment, the company applies a discount rate of 11%, which reflects the cost of capital and project risk. Next. So from the paragraph, we have a 2 point in here. The project using 3K investment analysis methods. The first one is net present value. The second one is profitability index. The third one is internal rate of return. And after calculating these 3 metrics, provide a recommendation to management. We have 2 questions. Number 1, should Nova Animation Studios proceed with the expansion? Why or why not? The question number 2 is, use your financial analysis to support a strategic business decision for the company. Next. So what we have to do, the first one, we have to searching for the net present value. We have the formula in here, NPV minus CFO plus CF1 until 16 years divided 1 plus K, 1 until 16 years. So given data that we have annual cash flow, $675,000. The second one, we have discount rate, 11%. We got to the decimal is 0.11. The third one, we have a number of the years. We have 16 years. And the last initial investment, we have $4 million. So the required of this, calculate the net present value of this project. Next. Okay, we have the solution. So we have the formula. I'm sorry. So we have the formula minus CFO plus CF1, CF2, CF3, CF4 until CF16 divided to 1 plus K1, K2, K3, K4, K5 until K16. So the initial investment, we have a minus $4 million, and we include the CF1 is 675,000 divided 1 plus discount rate, we have 0.11. We have year number 1, year 2 until 16 year. So minus $4 million, we've got this all. And the last result is 934,000.29. So this is the last result. The consolation of this, the NPV or the net present value result of this project is positive. We've got the last result, which is show that this project provides added value for the company. So the next, The step one, we have to searching of profitability index. We have the formula, present value divided in initial investment. Given data, we've got the last result of net present value, 934,000.29. The second one, we have initial investment, $4 million. The third one, present value. To get the present value is from the initial investment plus the result of the NPV. So we get the result of present value, 4,980,944,000.29. Okay. And then the next is we've got the required, determine the profitability of the project relative to the initial investment. Next. So we have the solution from the formula, present value divided initial investment. We've got the present value, 4,980,934.29 divided 4 million. We got the last result for the profitability index is 1,245. So the consolation is the profitability index result of the project is 1,245, which is more than 1, indicating the every dollar investment produce $125 in present value, which means this project is profitability. Next. Okay. So the last is we have to searching the internal rate of return. The formula is K1 and PV. We got the positive NPV, and then K2 minus K1 divided negative NPV minus positive NPV. So the given data, we have annual cash flow, $625,000. The second one, we have discount rate between 11% until 16%. The third one, we have the number of the years, we have 16 years. And the last, we have initial investment, $4 million required. Find the internal rate of return for the project. Next. So in here, we have the solution for the internal rate of return. For the first thing we have to do is searching the K11 until K16. So we've got K11. The last result is 980,934. We're searching for the K12. We've got 740,000. For the next K number 13, we've got 457,620,000. And then we're searching for the K14. The result is 228,920,000. We're searching for the K15. The result is 90,108. And for the last, we have the K16. We've got minus 173,765 for the last result. We need to searching for the K1 and for the K2. We've got the K1 is K11. We've got the K2 is K16. So after we found, we included to the formula ERR. So NPV first, we got from the K1. NPV minus, we've got from the K2. Minus NPV positive, we've got from the here. And then the result is 50,280, 50,248 into the 50.3. So the consolation, the result of initial return of this project is 50.3. These results show that it is higher than the cost of capital, which is the cost of capital is 11. So indicating that this project is financial feasible. So next. Okay. So after calculating these three metrics, provide a recommendation to management, Nova Animation should process with the expansion of its production facility as the project meets all the criteria for investment. The project not only adds value to the company, but also has acceptable risk based on the internal rate of return being higher than the cost of capital. Okay, so I think that's all for me for case study number 1. So thank you so much. For the case study number 2 will be presentation by Rama. Thank you.
Okay, now I will present a case study 2 about expansion of Velocity X Motors product line. Next. So Velocity X Motors, a renowned manufacturer of high-performance skateboards in Australia, is considering expanding its product line by introducing gas-powered skateboards. This decision is driven by the increasing demand for alternative transportation solutions, providing an opportunity to attract new customers and boost sales. The management projects annual sales of 2,000 units over the next 10 years, after which solar-powered skateboards are expected to dominate the market, leading to the discontinuation of gas-powered model. To assess the feasibility of this expansion, a, a thorough financial analysis is necessary, focusing on the initial investment requirements, project cash flow, and investment viability through NPV analysis. Next. So the first calculation is initial investment needed for Velocity X motors. This includes the new production equipment of $450,000 and $50,000 allocated to net working capital. In total, the company had to commit $500,000 or $500,000 upfront to get the project off the ground. Next. Next is to calculate the annual net cash flow estimation for the first 9 years of the project. To do this, we use the formula operating cash flow equals net operating income minus tax plus depreciation expense. Then the given data includes 2,000 units sold annually, selling price of $200 per unit, variable cost of $40 per unit, annual fixed cost of $160, and a marginal tax rate of 34%. Using these figures, we are required to calculate the expected annual cash flow from year 1 to year 9. Next. For the solution, first we calculate the revenue by multiplying 2,000 units by the selling price of $200, which give us $400,000. And then the cost of goods sold is 2,000 units times $40, resulting in $80,000. We also include depreciation, which is based on the $450,000 equipment cost spread over 10 years, so that $45,000 per year. After subtracting those variables and fixed costs of $160,000 and accounting for depreciation, we got net operating income of $115,000. Then we apply the 34% tax rate, we got 39,100, and then we add back the depreciation expense to arrive at the operating cash flow of $120,900, which can be summarized. The expected annual net cash flow from year 1 to year 9 is $120,900. Next. Next one, we calculate the annual net cash flow for year 10 remains the same as in previous years, which is $120,900. However, in year 10, we also factor in the recovery of net working capital, which amounts to $50,000. This is the amount initially invested and now returned as the project ends. So the total terminal cash flow in year 10 is the sum of both, that equals to 170,900. Next. To determine whether this project is financially viable, we use net present value or NPV analysis. The formula for NPV is minus CF0 plus CF1 to 10 divided by 1 plus K powers 1 to 10. And the given data, the initial investment in year 0 is minus 500,000. From year 1 to 9, the annual cash flow is $120,900. In year 10, the terminal cash flow is $170,900. And with the discount rate 10%. Using this data and applying the NPV formula, we are required to calculate the total net present value of the project to decide whether it's a profitable investment. Next. So for the solution, we got the minus CF0, which is minus 500,000, and we add by CF1 through CF10. Then we got the final calculation, that is $257,655.34. And for the conclusion, since the NPV is $257,000, 655.34, this indicates that the project is financially viable given the projected cash inflows and a strong NPV. Velocity X Motors should proceed with the expansion as it will generate significant returns over the 10-year period. That's it for case study number 2.
Okay, now let's move on the case study 3 about expansion decision at quantum test solution. Next. Okay, so a test company from Japan that is deciding whether to build a new factory to produce memory cards. So the reason for building the factory is because the demand for data storage is increasing. The cost to build the factory is 800 million yen, and it will be used for 5 years. The company used the straight line depreciation method, which means the factory cost will be divided equally over 5 years. Each memory card will be sold for 15,000 yen. Here are the costs. Variable cost per card is 10,000 yen, and fixed cost per year is 180 million yen. Before starting the project, the company want to calculate the break-even point to know how many memory cards must be sold to cover all the costs. So, how do we solve this? Next. Okay, here what we know. For selling price per unit is 15,000 yen. Variable cost per unit is 10,000 yen. Annual fixed cost is 180 million yen. Initial investment is 800 million yen and useful life is 5 years. So the question is how many memory cards must be sold to break even? Let's solve this step by step. Next. Okay, so step 1, calculate depreciation. To calculate depreciation, we use this formula. Depreciation is equal to initial investment divided by useful life. We know the investment is 800 million yen and the useful life is 5 years. So 800 million divided by 5 equal 160 million yen per year. Next. So step 2, we calculate total fixed cost. Total fixed costs include annual fixed cash costs, which are 180 million yen, and depreciation, which is 160 million yen. So the total fixed costs are next equal 340 million yen per year. Next. Step 3, calculate the break-even point. So we use the formula. The formula is break-even is equal to total fixed cost divided by selling price minus variable cost. Next. That means 340 million yen divided by 15,000 yen minus 1000 yen. So 68,000 units. Next. So what does that mean? The company must sell at least 68,000 memory cards per year to break even. If we look at the graph, when the company sell 68,000 units, the total revenue and total cost but reach 1,020 million yen, which is the break-even point. Next. Okay, so consolation and strategic recommendation. Quantum Tech Solution must sell at least 68,000 memory cards per year to break even. Selling below this level will result in losses as revenues won't cover fixed and variable costs. Market expansion is feasible if the sales target is achievable. The product should offer competitive advantage such a faster rate or right span or agented security features. However, the company should also consider risks like intense price competitive, high production costs, and declining demand due to alternatives like SSD and cloud storage. Okay, so that's all for me for case study 3, and the final case will be presented by Tias. Thank you.
Let me continue to case study 4, equipment decision at Nexatech Solution. Nexatech Solution, a leading semiconductor manufacturer in South Korea, is planning to acquire new high-speed precision equipment to improve its microprocessor productions. To finance his acquisition, the company is considering two alternatives. The first option is a loan of 250 million with a 6-year term and an annual interest rate of 9%. This loan would be to purchase the equipment, which is expected to have a residual value of 30 million at the end of its useful life. The applicable corporate tax is 35%. The second option is to enter into a 6-year lease agreement with Prime Leasing Corporations, which requires annual lease payment of 52 millions. These lease payments are tax deductible. The management team must carefully evaluate these financing options to determine which is more financially beneficial for the company. Next, as a financial analysis for Nexatech Solutions, my role is to conduct a comprehensive financial analysis to help the management determine the most cost-effective financing option for acquiring the new high-speed precision equipment. The analysis will cover both the loan and the lease alternatives. For the loan options, I will calculate the after-tax cost of debt financing, compute the total cash outflow including loan repayment and tax effects, and assess the depreciations benefits gained from owning the equipment. For the lease options, I will determine the after-tax cost of lease financing by considering the tax deductibility of the lease payment and calculate the total cash outflow over the 6-year lease period. After completing the calculations for both alternatives, I will compare the total cost to identify which options provide the lowest cost and the highest financial benefits for the Nexatech Solutions. Additionally, I will consider other financial risks such as interest rate risk, residual value risk, cash flow implications, and tax regulation change that may affect the final decisions. The result of this analysis, along with strategic recommendations, will be presented in a detailed report for the company executive team. So this is the given data by the case. So the loan amount is 250 million with 6-year terms. An annual interest rate is 9%. Residual value of equipment is 30 million, and the tax rate is 35%. And the last equipment cost is 250 million. I have to do is calculate the after-tax cost of debt financing for the loan option. So this is the formula to search the after-tax cost of debts. So the result is 5.85%. Continue to the second assignment. So I have to compute the total cash outflow for purchasing the equipment, including loan payment and tax effects. So I'm using two assumptions. So the first assumption is loan payment are made at the beginning of the year, and the second assumption is loan payment that made in the end of the year. Before we get to the next assumption, we discuss this assumption first. So this is the formula to get the loan payment. So the result is 51 million. So next we go to still with the computed the total cash outflow. So first we find the annual depreciation expense for the depreciations in the table. So the depreciation is 36 million. So this is the table. The conclusion is based on the analysis of the loan debt alternatives. The total present value of cash outflow is 172 million. This shows the total cost the company will bear if they choose the loan option to finance the equipment purchase. This cost include loan payment, interest, tax savings from depreciation and interest, and the residual value of equipment. Next, we go to the assumption B. Loan payment are made at the end of the year. So this is the formula. If we're using the B assumptions, is different from the A, and the result is 55 million. And this is the table, and the conclusion is based on the analysis of the loan debt alternatives, the total present value of cash outflow is 172 million. This means that if Nexatech solution choose the loan option, the total cost after considering interest, tax savings, and residual value will be 172 million. Next, we go to the lease option analysis. So the given data is lease payment is 52 million and the tax rate is 35%. And next we go, my assignment is to determine the after-tax cost of lease financing considering the tax deductibility of lease payment. This is the formula to get the after-tax lease cost. Is the same with the loan one. So the result is 33,800 million per year. And after that, we compare the total cash outflow for leasing over the 6-year period. In assumption A, the total is 184 million. In assumption B, the total is 171 million. So based on the analysis, leasing with payment made at the end of the year, assumption B, is more cost effective than payment made at the beginning of the year, assumption A. The present value of cash flow for assumption B is 171 million, which is lower than assumption A at 184 million. They show that paying at the end of the year is better because it's reduced the total cost due to the time value of money. Therefore, it is recommended for the company to choose lease payment at the end of the year. And last, we go to the final recommendations. So which financing option provides the lowest cost and highest financial benefits for Nexatech solutions? So based on the analysis of the total present value of cash outflow over 6-year period, the lease option with payment made at the end of each year is most cost-effective alternatives. The loan options result in a present value 172 million for payment at the beginning of each year and 172 million for payment at the end of the at the end of each year. Meanwhile, lease option result in present value of 184 million for payment at the beginning of each year and 171 for payment at the end of each year. Therefore, if the company primary objective is minimize the cost of capital, the lease option with end of the year payment is the optimal choice with the lowest present value of 171 million. And the last question is, what additional financial risks should be the company consider before making a final decision? Before deciding between a loan or a lease, the company should consider several financial risks. This include interest rate risk, where loan rates may increase, residual value risk, where assets depreciation may be higher than expected, and obsolescence risk if the assets quickly become outdated. The company should also assess the cash flow risk due to high loan repayment or long-term lease commitment. Other risks include debt confidence risk, tax regulation change, termination penalties, and inflation risk that could increase future payment. If evaluating these risks, it's important to ensure the best financial decision. That's all from me for case 4. Thank you.
Okay, I think that's all from us. Thank you, Karina. Thank you, Tias. Thank you, Rama. So I hope from this presentation, everyone can know about the NPV, ERR, or anything about the institution subject. I think that's all. Thank you, guys. Good night.